Is Verizon a dividend trap, and are we expecting a dividend cut over the next year or two? Let's find out. As always, we're going to run through the historical performance of Verizon Communications. We'll look at their top line growth year on year as well as their bottom line net income growth. We'll take a look at the health of this company, in particular their total cash versus their huge total debt amount. We'll also take a look at the return of this company versus others in the same industry. And we'll look at their dividend safety, talk about the net debt to EBITDA metric, look at some other financial metrics to see how well they are positioned over the next few years. We'll talk about some insider selling that we have seen by the president, and we'll also take a look to the institutions in the more recent quarters to see whether or not they have been buying shares of Verizon. And as always, we will run them through the valuation model, getting to the intrinsic value as well as the acceptable buy price, given our investor margin of safety, and look towards Wall Street to see what they expect over the next 12 months. Starting off then with their historical performance, we can see over the last year they are down around 1%, over the last 10 years down around 11%. They are, however, trading currently towards the upper end of the 52-week range. The yield sits at 6.31% with a forward PE of 9.17. In terms of their top line, 3 to 7% is our target year on year. 132 billion reported in 2019, 134 billion in their latest annual report, December 2023, that was released last week. So as we can see, very little movement over the last 5 years. On a more granular level, they decreased their revenue to 2020 before increasing it all the way to 2022 before seeing a drop. So yes, it's increased very minimally over the last 5 years, and in between we have seen some negative growth. In terms of the bottom line, 19 billion reported in terms of net income in 2019, 2023 11.6. So in actual fact, while the top line increased marginally over the last 5 years, the bottom line net income in fact decreased. 2019 decreased to 2020 before an increase and then a decrease subsequent years to 2023. So bear in mind the top line did increase marginally, but we did in fact see the bottom line nearly half in terms of that net income. Total cash and short-term investments versus total debt, 2.6 billion reported in 2019. Latest quarterly report, 2 billion, 2.1. So a very small drop to their total cash. Now, in terms of their total debt over the last 5 years, what we see, 134 billion increased to 175 billion. Now, this is a red flag indicator. Obviously, we understand with the communications industry, we understand there is a lot of debt, but the fact is it has increased significantly over the last 5 years, and it is a bit of a worry to see what we expect over the next 5 years and if this continues to increase. Now, in terms of their performance versus others in the industry in the integrated telecoms, we have AT&T, Deutsche Telekom, BCE, Nippon Telegraph, and a few others. Now, over the last year, no surprise, Verizon was on a very positive run. Total return up 6.5%. Remember, that includes those dividends reinvested. If we look over the last 5 years, we see Verizon negative 1%. Still, after their run that they went on in the recent period, down 1%. Significantly behind AT&T, up 10%. So, yes, they may be the worst performing over the last 5 years, but bear in mind, past performance isn't necessarily an indicator for future performance. In terms of insider selling, well, as always, insider selling isn't bearish in my opinion. Management do sell for many reasons, personal, financial. Insider buying is really a bullish signal as we discuss. We can see here the president of Global Services selling on 2 different occasions, end of November, middle of December, and he sold around 1 million worth of shares. Interesting to note that the share price is up around 9 to 10% since he sold. But again, this is just one level of our analysis, nothing that we would take too seriously. In terms of institutional ownership, 61%, 11 billion worth of sales by these institutions over the last 12 months, 21 billion over the same period. So essentially more buying, nearly double as much buying than they were selling over the period. What I want to draw your attention to though is over the last 2 quarters, we do see the institutions, whilst they have been buying, more selling in both Q3 and Q4 of 2023. Again though, we should always do our own due diligence and this shouldn't be a trigger for buying or selling. Verizon then, dividend safety score 70, it is safe. Market cap 177 billion, it is a mega cap company. In terms of those key recessionary metrics, well, they increased the dividend in the last recession, above average growth, and outperformed the S&P negative 38% to the S&P's negative 55. Dividend growth, pretty mediocre in September last year, 1.9%. So remember, you are getting lower than inflation. Over the last 40 years, the US inflation rate on average was 4%. If you're getting less than that, whether it's your salary, your dividends, your other income-producing assets, you're losing your purchasing power and, in effect, taking a pay cut. We see that over the last 5 years, over the last 20 years as well, it is below 4%. Just something to consider, even if the yield is very high, but year on year, that is lower, the increase than inflation. Just something I want to draw your attention to. 17 years of consecutive increases, and they have been paying a dividend for the last 40 without a reduction. In terms of dividend yield theory, we have a sign of undervaluation, 6.4% versus 4.59%. Bear in mind, though, we don't look at any of these models in isolation. We'll draw a conclusion towards the end. Forward PE 9 versus 10.4, another sign of undervaluation. And we note the communications sector PE is significantly higher at 18.5. Now, if you're a regular viewer, you know what we're about to say. The earnings is susceptible to manipulation by management through accounting. We run it through many examples. We can do it again today. Free cash flow is what we look at. Below 70% for telecoms. Usually I like to see below 60%. However, for telecoms, I do increase that as they do pay a large amount of both their earnings and free cash flow as dividends. Now, these are a few reasons why we call this a red flag indicator. 2022, if you look to the earnings 50%, you'd be fairly happy. It's below 70%. 104% on the free cash flow. It means that management paid out more in dividends than they generated in free cash flow. Massive red flag in 2022. And if you were spot on to that, you would understand and expect a mediocre dividend increase that we saw. 2023, still a bit too high for my liking at 86%. At least it is below 100%. But again, for 2023, 2024, I would expect a very small dividend increase, at most increasing in line with inflation at 4%. Better news though, 60% is what they expect in 2024. Free cash flow per share, it is decreasing over the long term, 389 in 2014, 307 in 2023. We do see very, very inconsistent year on year. 2021, negative 683. In more positive news, 2024, they are expecting free cash flow of $4.45 per share. Sales growth, very inconsistent. Again, expected from the telecoms industry. Steady, moderate growth, though, is our real target. 2023, negative 2%. The last 2 years, pretty mediocre at best. So something just to consider. But it is okay if you do understand what you're investing in. It's a telecoms company. You're not looking at a technology company with fast growth or a mature company with Coca-Cola. Always understand what you're investing in and have realistic expectations. 127 billion in 2014, 134 billion in 2023. If I'm completely honest, if we factor into inflation 4% year on year, in actual fact, their real terms revenue has been decreasing. Another negative, we love it when companies do share buybacks, returning excess cash to investors. We see the opposite. They have diluted your position over the years, issuing shares. Not as much as maybe you would expect, but still something just to note here. ROIC, now 10% or more is my personal favorite, given the faith management are able to effectively allocate their capital. What we can see here is the opposite. Now, look, we'd like to see these double digits, but what I would say, and it is very, very obvious, the ROIC, their return every single year has been decreasing. Now this, you might say 9 to 10% over the last few years, it should be okay. It's a red flag indicator. The reason for that, it's been decreasing year on year. Please understand that if we were here in 2018, we'd look back and say it's been decreasing, but only for a few years. We're now in 2023, or have the data for 2023. It has been decreasing pretty much every single year. Something just to bear in mind. Who knows, it may start to go back up, but these are things that I just want you to be thinking about. Operating margin, in better news, it is consistently above the minimum we look for in the telecoms. Last few years in the low 20s, fairly positive to note. Free cash flow margin, it does straddle around that 7%, sometimes better, sometimes a bit worse. But over the last 2 years, it is looking positive to say. Finally, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Now, this shows us the dividend safety as well as the balance sheet strength, and we want it below 3.5 for telecoms. These are the number of years it would take the company to pay off all of their debt net of cash on hand. 3.62, now it's above the 3.5 maximum we like to see in 2023. 2024 expected to be lower. Now, Because it's expected to be lower, that is positive. What I would say about a dividend cut, we have seen the free cash flow payout above 100% last year. Now, this year it is expected to be 80%, the following year around 40%. So they are making a much better use of the payout in terms of how much they're paying out dividends. Net debt to EBITDA, what I would say is it has increased to 3.62. I would keep a very close eye on in 2024. Ideally, it does come below the 3.5 that we see, but if we suddenly start to see it go back up and increase, same with the payout ratio, then that is where I could say we do look to be in a bit of trouble, or we will see very, very minuscule increases to the dividend, 0.1%, 0.2%, that we have seen from other struggling companies over the last few weeks. Now let's jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So let's get into the first model, Graham's valuation. We have the earnings per share, the growth rate per analyst estimates, and the AAA corporate bond yield, giving intrinsic value of $48.40. So we have our first sign of undervaluation. Keep in mind, we don't look at any of these models in isolation. Second model would typically be the multiples valuation model. However, given the only comparable, in my opinion, would be AT&T, and they have a negative earnings per share, this isn't relevant for today. We then look at the dividend discount model. With the dividends, we can see year on year they are increasing it by below inflation, just something to consider. Average growth rate 1.84. Forward looking, we have gone 1.75, just slightly lower, and we can see the intrinsic value comes to near enough the current trading price, around $1.50 more, so we get that undervaluation signal. The DCF model, we have the free cash flows year on year, average growth rate 14.5%, growth rate moving forwards a bit more conservative and lower than analyst targets. With our discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divided by shares outstanding, we get an intrinsic value showing undervaluation. So the intrinsic value for today's episode of Verizon is the average of these three models, which does arrive at $45.84. And don't forget, you can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list by clicking on that pinned comment below. So typically, margin of safety, we start off with 10%, which we use if we believe it meets three criteria: wide moat, strong financial metrics, good forward-looking data. We can see for today's episode of Verizon, it's pretty much at that 10% margin of safety. Now, for a telecoms company, there were a lot of red flag indicators. So for me, if this was one I would be looking to add, I would be wanting a much larger margin of safety. However, for me personally, adding into the telecoms industry in the portfolio is definitely not on my radar anytime soon. But for those that are interested, if you did want a 15% margin of safety, that would be the applicable price. 20% we can see there, 25%, and I'll go up to 30% for those that want to see. So right now we see it at a 10% margin of safety, as we mentioned, just a few cents shy. In terms of Wall Street and what they forecast, well, their price target is $45. They see upside of 8%. So as I mentioned, there are some signals that we can see that could lead Verizon into offering or into, in fact, establishing a dividend cut, but that would really come down to their free cash flow payout. We have seen it go over 100%. If it does continue over the next year or two and we see their net debt to EBITDA levels rising, this could be a real worry for shareholders. Right now, however, based on the information that we have, I would say it does seem to be safe. It also has a safety score of 70. As always, though, let me know your thoughts in the comments below. Have a great day. See you on the next episode, and smash that like button.